Wonderful. Welcome, everyone. I'm so excited that all of you are here today. I'm gonna introduce myself, introduce our wonderful panelists, but want to start out first with some logistical things for the day. We're so excited to have you for our program on Loans 101 for Creatives. We do have ASL interpretation available, so please go to that gallery view and pin our wonderful interpreter, Anne, to your screen so you can make sure you can see her throughout the webinar. We have some incredible co-presenters, experts, creatives, panelists with us today. We're going to share their wisdom, their expertise, and also hear from you all about what are your questions when it comes to lending and loans in the creative industry. So for those of you who have been on a Zoom webinar before, you will be very familiar with that Q&A. We're going to leave some time at the end, as you'll see from this agenda, which I'll run through in just a sec, for your questions. So please feel free to use the Q&A as well as the chat throughout this webinar, and we really want to hear from you about what are the questions you're bringing to this space. A little bit of overview. I'll do an intro of myself and of Arts Alliance Illinois. For those of you, maybe this is one of your first programs with us, in which case, welcome. We're going to have an incredible panel conversation with some lenders about common concerns, common questions, common misunderstandings about process of getting a loan, particularly for the creative sector. We're going to hear from some incredible creative business owners today on our panel. I'm really excited for you all to hear from both of them. And then we're going to get to the questions. Again, please feel free to use that Q&A during our webinar, use the chat, and we will get started with a little bit of intro about Arts Alliance. So my name is Jess. I use she, her pronouns. I am a newer member of Arts Alliance, and I'm really excited to be a part of our public funding navigation team. We're putting together, this is one of the first in a series of webinars and workshops really designed to equip the creative sector with the resources that we need. And this is part of the Alliance's work statewide. So Arts Alliance Illinois is a statewide advocacy organization with focus on policy work, focus on connection to resources, and really with the goal of improving quality of life for not just the arts and creative sector, but communities statewide. And we work all across Illinois. We have artists and creatives from many different disciplines. And so you'll hear from a couple of folks in their or different disciplines and different experiences, different parts of the state today about their experience with lending and loans. This workshop in particular, let's go to the next slide, is a part of our public funding navigation work. So in practice, what that means is one piece of our many offerings to the creative sector, which also includes here research, trying to understand the issues at play in the creative sector, connecting people from across the state. And as you'll see, advocacy work and technical assistance, that's us, the help desk. Part of what we do is connect folks to resources to help navigate the sometimes complicated process of applying for public funding, government programs. We can help people figure out if they're eligible. We can help you actually walk through with specific programs, an application itself. And our help desk is really here to be that resource, to be that connection between you and the resources that you're looking for. So we'll also do some dropping in the chat of that link, but you can visit the help desk and actually talk with one of the folks on our help desk staff at support.artsalliance.org. If you like this workshop, which I'm sure you will, we have many other upcoming workshops about starting a creative venture, starting a creative nonprofit, the financial side, the legal side, the marketing side, and also just hearing from fellow creatives about how they've made their creative venture work. That's throughout the month of May, and we'll follow up with some more ways you can stay tuned about how to sign up for those workshops, which are really exciting. We're also going to be spending some time across the state visiting different communities, especially outside of Chicago, on our roadshow this summer. So stay tuned for help desk in person and across the state of Illinois. So I want to just remind everyone to use the Q&A function, use the chat. We are going to start with Brett. I would love you to introduce yourself, and I will just hand it off to you to get us started about talking through loans and lending for the creative sector.
Wonderful. Thank you so much, Jess. I'm going to do a very quick just hearing check. Can everybody hear me and see me? Everybody. Okay, good. My name is Brett Miller. I am the Director of Lending at IFF for Chicago and Northwest Indiana. And I use he, him pronouns. I'm really thrilled to be here today with the Arts Alliance of Illinois and to be in community with you all. As Jess was just kind of commenting about the Arts Alliance work, one of the things that I really just appreciate is this idea of research and advocacy and connecting the folks across the state to resources and helping folks navigate those resources. It can feel like a bit of a maze at times, and I really feel like as we go through our slides, both John and I, John Phelps, really kind of align well with that, the idea of helping organizations navigate this kind of difficult maze. So with that, IFF is a community development financial institution. We are a nonprofit community development financial institution headquartered in Chicago. I'll show a slide of our overall footprint. We were initially the Illinois Facilities Fund when we first started in the 1980s, but we've expanded to serve 10 different states. And so we can no longer be the Illinois Facilities Fund because we are in Michigan and Ohio and Indiana and elsewhere. But today we're going to be focusing primarily on our work here in Illinois. So IFF's mission is to strengthen nonprofits and the communities they serve through by providing leadership, capital, and real estate solutions, very similar to what the Arts Alliance does, how to sort of provide and be a resource to arts and cultural organizations or nonprofits across the state. Next slide, please. And so with that, we have some values. As a mission-based nonprofit lender, we try to really prioritize equity. We really value our partnerships. We try to go to places first and foremost where we are invited, and we really value, or we really focus initially on listening to our partners before coming in and providing any kind of solution. We also look to balance tensions, and as you probably will hear from the panelists today, sometimes there can be really tense moments in the process of navigating access to capital. And so sometimes it's just a matter of kind of figuring out where we can kind of alleviate some of those tensions and where are some things that we need to sort of like just navigate and work through. And then again, we're a mission-based lender, so we always are trying to steward with heart. Next slide, please. So IFF, as I mentioned before, we initially started as a lender to nonprofits across Illinois. As we have gotten more diverse in our product offerings, we've switched our name from a lender or having it be IFF Lending to Capital Solutions. And so some of that is related to not only the products that we are able to provide to organizations or nonprofits that are looking to get loans, but also in some of the technical assistance and the resources that we provide. So I've listed here a couple of our loan products. We are historically a facility lender, so we've worked with nonprofits that are primarily looking to either acquire or renovate facilities that they own, or like I said, acquire facilities to expand their capacity. But we'd also do capital campaign bridge loans, and we've done some equipment and vehicle loans throughout our history. The loan size tends to be as small as 10,000 and on up to 3 million. And we can do terms from between 5 years and 15 years with amortizations up to 20 years. Sorry about the lender speak on that. That's just the disclaimer that's on the slide. And our rates tend to be, are very competitive. One of the things I think that's really unique about IFF, and here's getting into some of our product features, we are a non-appraisal based lender. And as I mentioned earlier in the previous slide, we prioritize equity. And lending to facilities, especially in disinvested communities, has historically been steeped in systemic racism. So because of redlining and very poor policies for decades, the value of property in certain communities is not as high as it could be in other communities for the same exact built facility. So what we've done is we've removed the need for an appraisal to access a loan from IFF. Instead, what we do is we look at the cash flow or the operations that an organization has and the surplus that they generate from those operations to pay off the loan. We think that's a much more sustainable model and something that I think provides access to nonprofits and artists and organizations that are serving disinvested communities. We also do some other things, as I mentioned before, why we call it Capital Solutions. We do work with the New Market Tax Credit Program, which is a large federal tax credit program that helps also serve disinvested communities to get larger projects kind of built. But more than that, I think we're just open to the idea of providing technical assistance and working with nonprofits and organizations as they look to grow. And so, as I mentioned, that's this slide right here. Thank you, Jess. You read my mind. This is we also look at opportunities, and this is very similar again to the Arts Alliance. We're constantly receiving information about grant opportunities or programmatic opportunities that are coming through the state that could be really useful with our nonprofit customers. And a lot of these grant opportunities layer really well with a loan or, as I mentioned a slide before, in a capital campaign. So if let's say you were to receive a grant from the state, IFF is in a position to bridge that grant in the event that it's a reimbursable grant and you still need to get the project sort of off the ground. Next slide, please. And I mentioned our footprint. We'll focus real quickly just on that middle state of Illinois. Illinois is a very big state. We do have an office in St. Louis, which does work with a lot of the folks in Southern Illinois. I sort of go from Chicago down to about Springfield, and then my colleagues in our St. Louis office kind of cover Springfield and below, but we are all available to have conversations and talk about things that folks are experiencing in the market. And I apologize for this picture, last and but not least, but please do pay attention to the email. I'm more than happy to discuss anything with anyone about what they're experiencing, how you know, a loan could be right for you. But please do reach out. I would love to just hear people's stories and what they've got kind of in the pipeline in projects and what they're just working on in the arts. So that's I think I got it in my time. Thanks, Jess, there's a thumbs up. So with that, I'm most excited just to really to kind of get into our panelists. We've got some really amazing people today to provide some great resources and some information. And so I'm going to actually start by kind of kicking it off to Mr. John Phelps. He's the executive director at the Rockford Local Development Corporation, and he's going to talk a little bit about his organization and some funding opportunities that he's very, very expert in. So John, I'll kick it over to you, and then we'll come back with some questions.
Thank you, Brett. Pleasure to be here, and pleasure to meet you all remotely. I'm going to talk about microloans for arts businesses or businesses in general, but I understand the audience we have. These are commonly referred to RLF loans, revolving loan funds, which simply means we lend you the money, you pay us back, we lend it back out. RLDC is a private, not-for-profit economic development agency. We were founded in 1979. I wasn't here then, I'm not that old. And our primary activity is small business lending. We have over 400 loans outstanding, about $70 million. And because we're generally a piece of the financing, a bank might be the senior lender, we're subordinate to them, and perhaps there's other structured financing in that deal. we've leveraged about 220 million, 230 million of private capital in our projects. And we've impacted close to 7,700 jobs in our current portfolio. Our primary territory is Northern Illinois, Winnebago, Boone, McHenry counties. We're an SBA lender for the entire state, but those tend to be primarily real estate and $300,000-400,000 projects and up. RLF loans are really ideal for smaller loans. We limit our loans to 200,000 or 30% of the project cost. Again, we're trying to leverage our funds. We do a lot of micro lending though. If the loan's under 100,000, banks don't typically like looking at them. They're a lot of work. They don't make much money. And so we try and use our resources to finance those without a bank. We're typically used for subordinate financing, which means we're the greater risk in the deal. The bank would have a senior lien or a mortgage and we're subordinate to them. So they get paid first in a liquidation. They're very flexible. We can do real estate, equipment, working capital. Our rates tend to be project dependent. We're going to talk about Advantage Illinois today, which is a way we can access lower cost funds and then pass those lower cost funds to the borrower. And we have very nominal processing fees, typically $200-300 per deal. So this would be kind of a typical project we might work on. This might be a work living space for an artist. You're going to buy a building of $200,000. You need some operating capital of 20. The total project is $220,000. The way we would attack it is work with a bank who might be willing to provide the first mortgage of $100,000. We're always trying to get the bank to lend as much as possible, but sometimes with small businesses, as Brett alluded to, in underserved communities, real estate values can be an issue. So we're trying to get the bank comfortable to lend as much as they can. In this case, we're assuming 100,000. Today's market might be about 8%. The term 520 means that they would amortize the loan over 20 years. So the payment is set up on a 20-year basis. But they're going to balloon it in 5 years if for no other reason to reset the interest rate based on market conditions at that time. And then we see the annual debt service of about $10,000. We then come in behind them for 100. We use Advantage Illinois. Our interest rate then would be about 7%. We'll go 7 years with a 20-year amortization, but we can't go beyond 7 because the state statutorily cannot go beyond 7. The annual debt service there is about $9,300. So here's an example of basically 100% financing of this building. And your monthly payment is about $1,600 a month. Now, an alternative example is, let's say you need some operating capital, maybe some equipment, supplies. It's $30,000. Again, we would look to participate our loans with the state through Advantage Illinois. 7% interest rate is assumed, 5-year loan, and the monthly payment is about just under $600. That would be an example of one of our microloans. What is the underwriting process? Well, we want to learn about your business. So we'll either look at your business plan or spend time interviewing you. A business plan, if it's a startup, would be required. But if you're an established business, we just want to learn what you do, what's your market, who's your competition, that sort of thing. We are going to look at what are you going to use the money for and how are we going to fund it. We evaluate your financial condition. We'll look at your balance sheet. We compare you to industry standards. We want to make sure you're fairly liquid, you're not too highly leveraged, and that you can support this debt. We'll look at revenue growth and earnings growth. We'll compare those to industry standards. And we might be just projections if you're a new company, but it's always easier to underwrite an established business. Then we analyze your ability to service that debt. We analyze any collateral that's available as a secondary source of repayment, and we look at the borrower's creditworthiness. One of the issues on a loan like that is if you're leasing space and you have to build that space out, leasehold improvements is it's commonly called, are very difficult because there's no collateral. And so in my example of buying a building for a work-live space is much easier than if you're going to try and lease that building and improve it for your landlord. Something to keep in mind. Underwriting criteria. Can we go back to the other one, please? Thank you. There's basically 3 C's of credit. The most important is cash flow. Are you going to be able to repay us? And can we provide evidence based on your historical operations? If not, we'll look at the projections, we'll stress them, analyze them, and make sure they're realistic. We don't want to lend you money and get you in trouble if we don't think you can repay us. Then we look at a secondary source of repayment. What's the collateral in the event you're not able to repay us? Can we sell that collateral and hopefully satisfy the debt? And then we look at the credit rating of the borrower. These will minimum scores vary by lender, but typically the mid 600s is going to be required to get a loan. So if you're out looking for a loan, maybe one of the first things you want to do is check your credit score. And if it's very low, work to improve it while you're building your business model and your plan so that you'll be deemed creditworthy by a lender. Advantage Illinois is a program offered by the Illinois Department of Commerce Community Affairs, or Economic Opportunity. I am showing my age. And what they do is they work through conduit lenders, many commercial banks, and certain economic development agencies such as RLDC. We just happen to be the most active in the state, and so that's why I was asked to participate in this program, or this presentation. Advantage Illinois will purchase up to 50% of our loan. But to get 50%, you have to satisfy one of their public policy objectives. You're female owned, you're minority owned, veteran, you're in a rural area, your business is located in a low and moderate income area. There's a number of objectives. And the conduit lender would know if you're eligible for that. If you are, the state's money is at 2%. So in my example, when I said 7%, that means ours is 12, the blended rate is 7, and our rate is high because we borrow our money from a bank to lend to you, and we're paying prime, which is currently 8.5%. And if you don't, if you qualify for the public policy objectives, the state will buy half your loan. If you don't, they'll only buy 25%. And then the blended, and their rate is 2% less than the bank rate. So if the bank is 8, the state is 6, they're buying 25%. Your blended rate comes out to be 7.5%. And that's advantageous to the borrower. What's advantageous to the lender is the state will subordinate their position to the banks or the lender. So the lender gets paid first before the state, and that mitigates the lender's risk. The term of the loan may not exceed 7 years. They can make a longer amortization, but then you got a balloon payment. And if the lender agrees to refinance that loan, you're almost certain to have a higher interest rate because you no longer have that subsidized rate from the state. And I think that's it for me. Thank you.
Yeah, thanks, John. That was really, really awesome. I would love to just sort of ask you a few follow-up questions on that, on what you just kind of presented. First thing that I kind of noticed, you mentioned ways to improve credit scores, or as a suggestion for anybody that would be interested in coming in to financing, to work on improving their credit score. I'm wondering if you could maybe provide some ways or some tips on how folks might be able to do that. As you see it, what would make improve the credit profile?
Oh, absolutely. Oftentimes you'll see what's called a derogatory. Maybe there's a judgment or a collection on your report, and maybe it's an error or it's something very old, and you want to get that cleared up. So you contact the lender, whoever filed that collection, get that cleaned up. Those are particularly harmful to your score. If you have late payments, you don't want to be more than 30 days from when the payment is due. It shows up as a late payment. That will hurt your score. We've had a number of people come in and say, well, I don't have any credit, so my score must be good. That's not the case. It's better to get a charge card, maybe buy some groceries and pay it off at the end of the month and show that you can manage your credit well. You got to build credit, and that means you have to be active in the credit market. And then there are third-party credit consultants, managers that can help you manage your score. Just be careful when they say, we're going to get these all discounted by the lender, and that'll be great for you. Those will show up on your score, and they're considered a derogatory, that you've negotiated your debt down, and that will harm your score. So those are some thoughts.
Yeah, that's great, John. Thank you for that. This kind of like follows up on that a little bit. What would you say in your experience you've seen as some kind of common barriers in addition to maybe credit scores, common barriers for creatives and small businesses as they've looked to get into the capital markets and access loans?
Well, I mean, we've had people come in many times, and they have a great idea, they have great experience, but they have no cash. And that is almost a non-starter all the time, because the lender wants to make sure you have skin in the game. That if you open a business, you don't have anything at risk, and it starts off slow, and you can't take a paycheck, you're inclined to say, I'm done, and I'm going to go get a job. And then the lender's looking at a total loss. And then more practically, I think, is lack of collateral. You go into a bank, and the bank has their formulas. If you're creditworthy, we'll lend 80% against real estate. If it's in a questionable neighborhood or a special purpose car wash, something like that, maybe we'll lend 70%. If it's equipment, depending on what it is, maybe we'll lend 50%, accounts receivable, maybe 80%. And they go through this formula, and they arrive at how much they're willing to lend you based on these formulas. Well, if you're borrowing for working capital, marketing funds, product development, there is no collateral. And the bank will probably say, sorry, you've got a great plan, you've got good credit, but you don't have anything to support this loan in terms of collateral. And then sometimes you need to go out and get a co-signatory on the note, a co-guarantor, something like that, to try and mitigate that risk to the lender.
Yeah, that's such an important piece. I know you had the 3 C's of credit listed, and for those, there's also a couple other C's in some cases for the lending world, and one of them is character. But sometimes different institutions will focus more on the collateral than they will on some of the other pieces in that analysis. You mentioned working capital too is something that the Development Corporation does, and I'm wondering, and you just kind of mentioned that too as an example of, or having one of the barriers be limited cash to begin the process. And so I'm wondering if you could talk a little bit about the differences between working capital and facility lending, and how you kind of view that in terms of perhaps offsetting any of those barriers that you just mentioned.
Well, yeah, I mean, it's a fine line. It's easier to lend working capital when you don't need it. I mean, it's, get back to the old adage, if I didn't need the money, I wouldn't be borrowing it kind of thing. But um, we, because we're an economic development agency and a subordinate lender, we typically don't have very good collateral anyway. So we'll make working capital loans. We look for the other boxes, do you have good cash flow? Is the prospect of your business very good? Do you have good credit rating? Character, you're absolutely right. It's harder to measure, and unless you're getting police records and things like that or references. But we also mitigate our risk by, we manage 5 or 6 different portfolios, so we may spread it out. We may limit how much we're willing to lend, because to take a total write-off, it hurts a little agency like ours. So they're always a challenge. But if you're going to finance a building or some equipment, this expansion, you got to make sure they have adequate capital to support that business. And that's a critical element to the piece. Banks don't like to do it, so oftentimes it falls on us.
Yeah. Yeah, thank you for that. And I think that that's a perfect segue into my next question. I think one of the ideas behind this webinar is to think through traditional sources of capital and then some maybe alternative sources. Obviously, the Development Corporation in Rockford, IFF as a community development financial institution, we aren't banks. We operate similarly, but we also have different perspectives. And I'm wondering if you can maybe talk through a little bit about the partnerships and how you would sort of go about referring folks on the call to different partnerships or access to those resources that are different from the traditional sort of lending institutions. And I guess, how does this group sort of utilize their power to kind of tell their story and share their narrative to get access to those resources, even if they don't quite fit that traditional lending bucket?
Well, because we're also mission-based, as you are, we try and educate ourselves on what other products are out there. And unfortunately, for nascent businesses that don't have, they're looking for small microloans, there really aren't a lot of sources out there, at least not in our region, and I'm not aware throughout the state of Illinois. Many communities, if you're going to go in this business district, you're going to improve the facade of the building, we have a grant for you, things like that. But otherwise, you're at the mercy of the capital markets, and they're controlled by banks, and it's very difficult to access small loans. So many people rely on friends, families, maybe bring an investor in who has a financial objective or a strategic objective. I've got a construction company. I need a driver to haul my waste away. I'll finance your business to do that. But they're very hard to get. And I think our region of the state is fortunate because we manage so many revolving loan funds. We manage about $10 million of local capital, and we're kind of unique in this state for that, candidly. So.
Yeah, thanks for that. I just real quickly want to call out Tristan Brown from Justine Peterson is on the call, and so that's another
Oh, yeah.
CDFI that so thinking through how we build kind of coalitions and add access to different resources, like you said, it can be difficult, but hopefully this is the idea behind the Arts Alliance. How do we kind of provide the network and the ecosystem? So with that, you mentioned that you all are the sort of largest or have been doing the most active volume in the Advantage Illinois program. And I'm wondering if you could just talk through a little bit about that as maybe a specific opportunity for some of the folks on the call, given your deep experience there, and as we're talking about access to other resources.
Well, we look at it as part and parcel of our program. So we manage about 10 million. And if I can sell half of my loans to the state, I've got 20 million. Now we don't, not every loan we make qualifies or it's going to work, but it's always the default option for us on a direct loan. And we've always been active through every iteration of the program going back 20 years or more. So we're very versed in it. As we were talking before we started, I think we have 5 or 6 pending right now. Had one approved last week, and for us, it's again the default option. We want to use it. It's good for the borrower. It's good for us. And as much money as we can bring to our region from the state is great. So if you're from downstate and really outside our market, you want to go to their website and see who's in it. And there are banks that will be more aggressive than others, and you just want to keep hounding them and see what you have to do to access some of those funds.
Yeah.
And it's obviously picking up because we used to get turnaround time at about 3 or 4 weeks. Now it's closer to 8 weeks. So they're very busy.
Yeah. I think that's always an important piece for folks to understand, be transparent about the timing and expectations.
Absolutely.
So you mentioned having different partner lenders across the state. Obviously, the Development Corporation of Rockford, you're doing a lot of work for the county and for the city. Are there ways, I guess, for you all, if somebody were to reach out to you, would you be able to, or do you all provide any kind of technical assistance, or do you provide any kind of connection to other participating lenders that are maybe in a different service area or community?
Well, we would certainly try. We have also made loans outside of that immediate territory. We've done some in Chicago, Old Goldie, further in rural areas, recognizing that most of the rural areas don't have anything like what we do. But our board, we manage money for a multi-bank community development corporation, a private entity. And so they're not bound by territorial parochial interests. And so we'll use some of their money, participate with the state, but we just have to be parsimonious because we don't have a lot of money.
Right.
And the banks that fund this, their primary objective is economic development in this region. Yeah. But we have certainly done it outside the area. And we're happy to give people an idea how it works. It's just finding that lender can be difficult.
Yeah.
And you had mentioned Justine Peterson. I don't know if they're in the program, but if they're not, I would certainly encourage them.
Yeah, likewise. IFF is also in the program now. That's a recent development. I'll give a quick shameless plug there. So for folks, as John mentioned, sometimes resources can be finite. And so the more that we can collaborate and share with who has resources at different times, again, this is how you can leverage folks like John and I, and you used us to kind of get your end goals. I know I've got one last question before we get over to our amazing panelists that are in the field. But I did want to there was a question about amortization in the chat. And so I'm wondering if you could, in your slides, you talked a little bit about the payments as a result of the amortization, but I'm wondering if you could just kind of discuss real quickly the difference between term and amortization and how that impacts the end loan.
Well, yeah, I mean, so amortization is generally driven by the life of the asset being financed. And so if you're doing operating capital, if you make a 5-year loan, that's a long time because the inventory, the marketing, whatever you're using it for could be gone like that. And you got to pay for it over 5 years. We try and stretch it as much as we can because we're trying to limit the borrower's monthly payment, make it more sustainable for them. If you're a real estate, you can probably get 20, maybe 25 years. And equipment is based on kind of the useful life. If it's production equipment, 10, 20-year life, maybe you can get a 10-year loan, probably 7 conventionally would be a lot. If it's office equipment, it could be 3 to 5 years. And that's the way lenders look at it, is they would like that asset to be viable over the length of the loan. They may stretch out the payments, but then they make the maturity date. If it's a bank, it's going to be no more than 5 years generally. They want to, there's interest rate risk to them if rates move, and they want to be able to react to that. And they're generally comfortable up to 5 years, but seldom beyond. For us, again, we're willing to take more risks, so we'll fix rates longer, but we also have to be mindful of the economics of the deal and structure it accordingly.
Yeah, thanks, John. I really appreciate that. I know sometimes when we get into term and amortization conversations, lenders, we can use jargony things that don't always, aren't the terms that people use on a day-to-day. And so that's really helpful, I think, just to kind of frame it that way. I appreciate that.
Thanks,
so with that, I think that, I would love to kind of get into our next kind of step of the conversation with a couple of our panelists who are, fantastic artists across the state. And so I'm going to actually introduce real quickly. I'm going to start actually with Jasmine, if that's okay, and introduce Jasmine Allen. She is a director, a filmmaker, and writer living in Rockford, originally from Chicago. I just saw, so shout out Chicago. But Jasmine, I'm wondering if you could maybe just kind of to join the conversation, tell us a little bit about yourself and yeah, where you live, what you're working on right now, what you've been working on, and I guess we can maybe start with that, and then we'll come into your experience, maybe getting access to capital.
Okay, absolutely. I'm based in Rockford, Illinois right now. I produced a television series called Indie Rooftop, and I'm distributing it this coming summer. And I needed capital to produce the show. The show features independent musicians performances and interviews performing on Chicago's rooftops. And it's really cool. It has some popular musicians, and I was able to develop a proposal with those kinds of notes to try to get lending. I was able to secure financing from Allies for Community Business and Rockford Local Development Corporation, leveraging the Advantage Illinois program. Right now, I want to release the series this coming summer on my own platform, which is Zoe, and so that should be coming soon.
Very cool. Yeah, and Luke O'Neill, I would love to bring you in. Luke is from United Street Arts in Marion, Illinois. Luke, if you could maybe just kind of share with everybody on the call a little bit about you and what you're working on, and then also, some of the reasons why you were looking for accessing capital for your projects.
Yeah, thanks, Brett. Appreciate that introduction. Thanks, Arts Alliance, for having me here today. Thanks for everyone for listening. As Brett mentioned, I'm Luke O'Neill. I'm the owner of Union Street Arts in Marion, Illinois. We're a creative agency and studio that specializes in media arts, podcasts, video commercials. We do website development, but we also do creative events. We host art festivals every spring and fall, and we do live music on our stage that we have in our studio as well. So live music events. We also host summer art camps for kids, trying to foster and generate art opportunities for the next generation and get them participated and interested in arts. And we also dabble in public art murals as well. We've helped facilitate and establish a mural district in our historic downtown in Marion, Illinois, a hashtag Marion Murals, where we've been able to help facilitate almost 20 murals here in our local town. Regarding my loan, I was able to secure financing to purchase our building in 2022 through a traditional bank. It was a community bank that I was fortunate enough to secure financing with. And yeah, that's a little bit about me.
Thanks, Luke. So one of the things that I really loved about this panel was the different experiences and the different purposes that you all were looking to access funds. And I'd written down just a few notes as I was thinking about it. So Luke, if you don't mind, I just wanted to kind of start with you as sort of a follow-up. So your kind of use of arts in the community was really based on kind of place and sort of facilities. I'm wondering if you could kind of talk through some of the things that you learned in that process, thinking about real estate and purchasing a building and what that experience was like.
Sure. So I started this business in 2020 as with doing live streaming of music performances during the pandemic. I was in this building as a renter previously, and basically just started producing these shows. One thing led to another. We got involved in the mural district. There was a lot of incentive at the time to, just create a new placemaking for creative spaces in this town. And at that time, I knew that it was a good place to be. I knew it was where I wanted to be. And so right whenever in 2020, I knew if the chance could come, I would want to purchase the building. And it was a shot in the dark then, but it was a goal that I said I'm going to try for. And if everything led to the next 2 years to that point, it all happened. And one thing about the building is that it was the traditional loan. They wanted, it was, I don't want to say easier for me to get the loan for a building versus for some other reason. And it was just, I knew that there was going to be, it was just a very unique opportunity that I did not think would come again. And, I pulled the trigger and was able to save enough money for the down payment, which took about 2 years. It took that whole 2 years to do. And then, yeah, I just kind of had a feeling of what would happen in this neighborhood. And through my travels and working with artists across the country and world, I knew what happens to a neighborhood when artists come in and make it cool and becomes gentrified, and rent prices go up and artists get kicked out, can't afford it. So to hedge that, I bought the building.
Yeah, thank you for that, Luke. I was about to say that when we start talking about some of that might be a different conversation for another day. That I think you'd be great to lead. Yeah, so I think just kind of connecting some dots with what you were just kind of saying with what John had talked about before in terms of collateral being something that they really view. The real estate actually was a useful piece in the process for you. Jasmine, I'm wondering if you can maybe talk a little bit about your experience, given that the need for you was slightly different. It was more about the capital to create and produce something that wasn't necessarily based on a building, but more of like a content and an idea. And so maybe talk through a little bit about how you went into that kind of conversation and some of the things that you learned.
I think much like the Advantage Illinois program, you really want, as a business owner, you want to familiarize yourself with all of the DCEO opportunities. And so being a filmmaker, Illinois has the Illinois Film Tax Credit. And so I said, oh, well, you're giving back 30% here, potentially off of the project. And I would shop that to an in fact, I did shop it to investors before coming to RLDC, but after I had worked with the use of business credit and allies for community business. And I think that, granted, they had to think through it, but ultimately what it meant was like, hey, this is my 30% in here. And again, it being a targeted program for female entrepreneurs. Well, they changed the language a bit often on there, but at the time when I received my funding, it offered collateral support for women's businesses, and possibly minority businesses as well. And so I was like, well, you know, here's the more you familiarize yourself with what the government has available, it's easier to advocate for yourself as a business owner, because you can say, well, no, you got your 50% here, and then you got another 20% coming from here. And in addition to like doing whatever family, friends, and personal investments you can make.
Yeah, that's super helpful. You actually kind of led me right into my next question, so I'm going to follow up with you. What would be some things I think that you would advise everybody else? What were some things that I think that you learned that other beyond kind of knowing researching what DCO grants might be available or other grants are available? What would be some other things that you would advise folks on the call to think about as they go through a process?
I would say, like, one thing that's easy to get confused about is people say, oh, if you establish a relationship with XYZ Bank, you know, they'll be more likely to lend to you. That's not what that means for a big bank. A big bank is a good tool for cash flow support in terms of a business credit card. Don't ask them for a loan unless you are a millionaire. In that case, please email me. But if that's not the case, you really do want to focus on the lenders that are being presented in this program. Like you want to stick to mission-based lenders, micro lenders. You want to stick to CDFIs, because they're going to give you a fair shake, and they're going to look at your credit worthiness and let that speak, versus looking at just how much money you've made. And then even in the how much money you've made conversation, they really want to see a lot of money from a big bank. So I would say avoid that, and then that protects your credit because you have fewer inquiries. You really don't want to go past 5 inquiries in 2 years, because then you're not lendable. So you really want to research anybody before you ask them for a loan. And even with the CDFIs, you want to say, okay, what's the requirements? Get as much. A lot of people can be vague about it, but you want to be really clear. And then you want to know when they're running your credit, because it's like, if you already know you don't like me and my business from my credit, that's why you want to have that honesty, as much you want to establish somewhat of a rapport with the lender to get as much insight before applying as you can.
That's phenomenal advice. What are the requirements is such a good, making sure everybody is fully transparent. Luke, same question to you. What would you advise folks on the call, the things that you've learned?
I'd say the first thing is just to demonstrate your cash flow, that you have money coming in consistently to your business, whatever it looks like. and to also save, to start saving now, whether you think you need a loan today or in 2 years. If you can't demonstrate that you can save even $1,000 over, course of 12 months, why would you be able to, take a loan? It's not a good idea. So I would say definitely demonstrate cash flow, start saving now. And also I would say start your conversations now as well. Whoever you need to talk to, there's a lot of people that on this call that would be absolutely perfect to help guide you through navigating these sources of funding, but also take advantage of people that have been through the process before you. Is there an business incubator that you can tap into? Are there professional resources that you can have a consultation with? There's a lot of resources out there, but you just have to ask and seek them out.
Yeah, I think that's a perfect way, I think, for us to kind of complete our panel discussion. Certainly, as the intent of this webinar is to provide additional access to folks who can help folks walk through those questions. Jess, I'm going to actually kick it over to you for any Q&A that we might have. I know that there was a preloaded question. If you would like to read that, or if you'd like me to, I'm happy to, but I wanted to let you step in here first.
Thanks, Brett, and thanks to our incredible panel. I know there are some of you who are still on this call who may have some questions, so really encourage you to use that Q&A function. We would love to hear from you and what are some of the questions you have about loans, about translating the language of loans into the practical as we've been doing for the last couple minutes. I see Carlos has a question in the chat that I actually think is a really great sort of use case for maybe other folks, and maybe I'll just read it out loud and then kick it to you, Brett and John first, and then Luke and Jasmine. I don't know if this is something that you've ever considered or thought about or looked into, but maybe you have some insight you can share too. So Carlos asks, if I buy a house to live in and use it as a studio, can that be considered a part of a business? And can you get an Advantage Illinois loan to use something like a live workspace? John, maybe I'll kick it to you first because I think this was one of your examples.
Yeah, the state follows SBA rules, which are that the commercial space is supposed to be more than 50% of the total. So you have to be careful. You're walking a fine line. They don't necessarily object to living in a portion, but the majority of the space has to be for commercial purposes. The state is not a residential lender, and they're very careful about that. So
I would say in my experience, for my space, also how it is zoned, we are commercial zoning. And for example, they don't allow me to live in my commercial building. So I would say check your local regulations and laws as well when it comes to residing in a workplace.
that's good call, Luke. And when you get into urban areas, though, you do see a lot of residential workspace combined. The upper floor is residential, the ground floor is commercial. You just want to be creative. Maybe the steps upstairs are considered part of the commercial space leased to the residents, and that gets you over that 50% mark. It's that kind of stuff that you have to be mindful of.
Yeah, not to. I think both of those are excellent points. I have seen it. Permitting is also a big piece, and like John mentioned, in urban areas, sometimes I had a customer that had to go back and get re-permitted for something similar because the pitch of the steps was not right for residential or commercial. So the steps had to get removed totally, and it added $25,000 to $30,000 of cost to the project because the pitch, that's not the right term, but they were too steep. So again, I completely double click on what Luke and John are saying. You have to be mindful of a lot of things that you may not be thinking about initially.
Great. Thank you so much, everyone. I do just want to read this question that someone sent to us in advance, because I do think it is something that many folks on the panel or even who are attendees might be able to relate to. And again, if anyone wants to put another question in the Q&A, we would love to hear from you. This is someone who wrote in to say that applying for a loan and trying to get a loan has been an incredibly frustrating process. They've submitted to several banks, but we're told they don't have enough business credit history, but can't get business credit without getting credit in the first place. It's a ridiculous loop designed to keep people without deep pockets from launching their business. I'm curious for the lenders on the call, but also for you, Jasmine and Luke, if you had any experience sort of trying to figure out how to get out of this loop. Like how do you get credit in the first place, right? To build that and show that to a lender that you can, be a reliable investment for them.
Basically when you launch a business, before anything goes down, other than once you file, you have projections when you go to any lender for any money. And so you can use your projected revenue to qualify for a business credit card, and that'll get you using the business credit. And you can just use responsibly, and that'll demonstrate good business credit for you.
I would just say Jasmine's right. Depending on what you need, though, the credit card may not be sufficient. And again, most banks don't like doing small loans because it's as much work or more than a big one, and they don't make very much money off it. So I would concentrate on a community bank. Maybe like for Luke, you're in Marion, and there's a bank right down the street from your building that wants to see that neighborhood redevelop, and they're going to go the extra mile. Whereas a big money center bank would just give you a credit card application. So I would focus on small community banks that might have a vested interest in where you're located. That might be helpful.
Yeah, and I think both of those are really excellent. That's really excellent advice. Again, CDFIs are all a little bit different. There's different types. IFF, we are a loan fund. We actually don't do credit reports for our customers. And like I said, we're not looking at appraisal-based lending. So there's some advantages there too. That there are other folks out there, like John had mentioned, that are really, their mission is to see communities thriving and not necessarily just to, I don't want to be cynical about it, but making money off of transactions. And so it's just important to find those partnerships. And then I think, as John had mentioned, and Jasmine had said too, thinking through what are your what are your needs. So the business credit card could be certainly an option. Some folks are looking at retail line of credit with the bank, and the thing to maybe consider there, or your leverage or your carrot to offer a bank, could be the deposits from your business. And so they might be more willing to do either to start off with the retail line of credit, which allows you to build up some of that credit and perhaps graduate up. But those tend to be really relationship driven, and finding the right partners who are committed to what you're trying to do for that community. That's key.
I would just say, can you pay any bills through your business, whether it's internet? I mean, everybody uses internet. Start establishing small bills that just can demonstrate that you can pay what you say you will pay, and just start small.
With what Luke said, you want to make sure that whoever you're doing that with is a company that actually reports to the credit bureau. A lot of stuff, it would seem like your SiteGround and GoDaddy will report those kind of stuff, but they don't. So you want to find out what vendors actually are going to improve that credit.
Awesome. Thanks, everyone. Let's take this last question and then we'll move to a close. I do see Rebecca in the chat is asking about a situation where we might have multiple organizations who might be looking to acquire a building. And I'm curious for the lenders on the panel how it might work to have an organization trying to work in partnership with other organizations for an Advantage Illinois loan or another loan. Is that something that's possible, and how might that work?
Yeah, we see that occasionally. Typically, what they'll do is they'll form like an LLC, a limited liability corporation, and that each small business will be a member of that. And that will own the real estate, and then it will lease up the space to those individual businesses. And the individual businesses, the owners of those businesses, all have to guarantee the debt. But that is possible.
Yeah, and I completely agree. It's absolutely possible, and especially as real estate becomes more expensive, it's something that more organizations, I think, are really considering. I'm working with an organization right now on the south side that's basically done exactly that. They had one group that purchased a building, but always had plan or intent to bring in, I think, 2 to 3 other performing arts organizations. And then, so what the lenders, the responsibility of the lenders then is to look at the cash flow for that property that includes the lease payments with the renting organizations, but then also looking at the agreements between each one of those organizations to make sure that there's sort of everyone remains protected essentially through the operation. So it absolutely is an option, and really something that, you know, it requires a little bit of kind of planning, and I'd say probably a good attorney to make sure that all of the agreements are sound and buttoned up so that whoever winds up being the acquiring entity is protected.
Yeah, that's a great point, Brett. And I was going to mention that too as a caveat. Not only having a good attorney, but get a buy-sell agreement. Because when there's a dispute, like a bad marriage, that's not the time to try and negotiate how you're going to get out. You want it preset, so make sure that's a part of it.
And there are, I'll put a plug. I know the Arts Alliance might have some other folks too, but I know there's the Lawyers for the Creative Arts is a group here in Chicago that works, I think in some cases pro bono, but definitely works with arts and cultural organizations, perhaps across the state, certainly in Chicago, that helps them think through these types of things so that you know, groups are protected.
Thank you so much for everyone's thoughtful and interesting questions. Thank you so much to our incredible panelists. We are so excited to continue to bring together experts and creatives to answer these big questions about how to make it work as a creative in Illinois and the resources that are available to all of us and how to navigate them. We will be following up with everyone. There will be a recording of this in case you were not taking scrupulous notes, even though I'm sure you all were. And we really look forward to seeing you again soon at another one of our workshops or webinars. I'm going to drop a link to some of our upcoming programming that's about starting a creative business. Throughout the month of May, we'll be bringing together experts who are focused on creative businesses, creative nonprofits, and we're really excited to just continue these conversations. Thank you all so much for being here, and we look forward to seeing you at the next one. Thanks, everyone.
Thank you, Jessica.
Thank you, everyone.